Hello, everybody, and thank you for joining us. I'm Jill Ford, and I'm happy to welcome you to today's media briefing about the BIS Annual Report and the BIS Annual Economic Report. I hope you've already taken the opportunity to read the chapter that we've already released on the next generation monetary and financial system, which was released earlier this week. With me today are Augustine Carstens, General Manager of the BIS, Andrea Meckler, Deputy General Manager, and Hyun Song Shin, Head of the Monetary and Economics Department and Economic Advisor. Before we begin, I would just like to reiterate that the media briefing is on the record, but it is embargoed. It is embargoed until Sunday, the 29th of June at 11 a.m. Central European Summer Time. It will be recorded and we will publish that on our digital channels. So we'll start with Augustine giving a brief introduction on the two reports and then pass over to Hyun to talk about in more depth about structural shifts in the financial system, and then we'd be happy to take questions. So Augustine, over to you.
Thank you very much, Jill. And good morning, good afternoon, good evening for all of you, and let me start by thanking you for your interest in our annual economic report and also on our annual corporate report. Our annual report gives an account of our activity for the past year, with a particular focus on the delivery of our ambitious Innovation BIS 2025 business strategy. In our annual economic report, we provide our take on global economic and financial developments and on the pressing challenges policymakers face. This is in line with our efforts over the past 8 years to shine light on technological developments of key relevance for central banks as the guardians of the monetary system. Let me start by providing an overview of economic developments that sets the backdrop for our discussion today. We are at a pivotal moment for the global economy where we face challenges that are both immediate and structural. Recent years have tested the resilience of economies worldwide. We began in 2025 with cautious optimism, but developments have reminded us that stability is elusive. We face uncertain circumstances. Yet we also have opportunities to shape the outcomes. The announcement of broad-based tariffs by the US earlier this year marked the fraying of long-established economic ties and came on top of other ruminations in the US that heightened concerns about policy direction and stability and that are reverberating globally. Tariffs are at levels not seen in decades and will certainly exert significant pressure on both economic growth and inflation. The full impact will take time to show. In the meantime, elevated uncertainty may already be taking a toll. Sentiment has deteriorated. Firms around the world are reporting they are delaying decisions to hire and invest. Our annual economic report finds that even before these recent disruptions, the global economy faced persistent structural challenges. Weak productivity growth, fragile fiscal positions, and the buildup of financial vulnerabilities have long been areas of concern. These issues are now compounded by rapid technological advancements and rising trade fragmentation, which threaten to erode the resilience of economies and exacerbate inflationary pressures. As they face these new challenges, central banks can draw on the valuable lessons learned in recent years. The pandemic era reminded us that inflationary pressures can arise from multiple sources, not just strong demand. Central banks must carefully approach policy to find a balance between supporting growth and taking measures to avoid persistent inflation. We know that households are less tolerant of price increases, with inflation expectations much more sensitive after the experience of post-COVID inflation. If central banks see evidence that inflation expectations are rising too high, they must respond quickly and forcefully to restore price stability. Uncertainty surrounding the timing, magnitude, and future trajectory of tariffs further complicates this task. By staying true to their mandates and adapting to evolving circumstances, central banks can continue to anchor expectations and foster stability in an unpredictable world. This is the path to maintaining trust and contributing to sustainable economic growth. The path forward requires responses on multiple policy fronts. Structural reforms are essential to strengthen economic resilience, including measures to bolster labor market flexibility, reduce barriers to trade, and enhance public investment. At the same time, governments must tackle the challenges posed by historically high levels of public debt by ensuring credible and sustainable public finances. Finally, this is my last presentation of the annual report as General Manager. In our annual report, we give an account of our activity for the past year, with a particular focus on the delivery of our Innovation BIS 2025 business strategy. This bold and ambitious program involved transformational changes to modernize the bank and adapt to a fast-moving world fueled by technology. I'm proud to say we have achieved all the goals we set for ourselves on time and on budget. The report details how the strategy delivered many tangible achievements that have been embraced by the central banking community. We are now producing more research on a broader set of topics than ever before. The suite of products offered by the banking department has increased and business volumes have grown. Meanwhile, the launch of the BIS Innovation Hub has positioned the bank as a thought leader in the technology sphere. We have addressed topics at the intersection of cutting-edge technology and issues at the heart of central bank mandates, such as the provisions of central bank money, supervision of banks and other financial institutions, and delivery of fast, secure, and efficient payment infrastructures. Thank you for your attention, and I look forward to your questions. But before, I think Hyun will.
Thank you. Yeah. Hyun, please.
Thank you, Augustine. For my part, let me give some more details on the Chapter 2 discussion on the structural changes in the global financial system and the increasing footprint of portfolio managers. The Great Financial Crisis was a watershed event that set in motion two related structural changes in the global financial system. Those changes define the state of the system today. First, the focus has shifted from lending to the private sector, especially in the form of household mortgages, towards lending to governments in the form of sovereign bonds. As a result, global portfolio managers holding sovereign bonds have taken center stage in the financial system. One consequence is that cross-border bond holdings have increased, accompanied by the expansion of derivatives markets that have allowed asset managers to invest globally while hedging against currency risk. FX swaps allow borrowing in one currency with another currency as collateral. This market is very large, standing at $111 trillion. Given the important role played by non-bank financial intermediaries, or NBFIs, a more holistic regulatory approach is warranted. Banking and non-banking activities that pose similar risks should be subject to similarly stringent regulatory approaches. There is also a need to better monitor the amount of leverage these asset managers and funds build up and the extent to which their actions and positions amplify existing stress. Another implication of these far-reaching changes in the global financial system is that links between financial markets are tighter. This means that financial conditions are transmitted more powerfully across economies and in multiple directions. It's not a one-way street. Our analysis shows that monetary policy still largely steers domestic financial conditions. But when calibrating policy, central banks must be attuned to global financial conditions and how they react to central bank decisions, and to anticipate the effects of policy actions elsewhere. The increased sensitivity to global risk factors calls for a deeper understanding of the cross-border challenges baked into a more market-based financial system. It also underlines the value of cooperation, as well as regular information sharing and exchange of views among central banks.
Thank you very much. We now open to questions. So you can raise your hand. We ask if you raise your hand that you also turn on your camera when answering the question. If you're calling in by phone, you can also put a question into media@bis.org or put a question in the chat. So I saw Natalie Olaf Ors from Agence France Presse putting up your hand first. So Natalie, you have the floor. So we see you. Yeah.
Can you see me?
Yes, we can. Hello.
Okay.
Yeah.
Okay. I wanted to see in the report there are several references to the importance of the independence of central banks. And currently there are in several jurisdictions, there are several attacks, political attacks against the independence of central banks, including there are tensions in the U.S. between the president and the head of the Federal Reserve. If you could remind us, I don't know if you want to comment on this case in particular in the U.S. If yes, that's great. But if not, could you remind us as to why it is important for central bank to be able to maneuver independently from any political pressure? Why is it important for household companies, the economy in general?
Thanks, Natalie. I think we can answer that in a general sense.
Hello.
Yes, Augustine.
I think, well, first, thank you very much for the question. It is important to keep in mind what are the reasons behind the need of having an autonomous central bank. Through history, we have had quite substantial episodes where monetary policy mismanagement has led to devastating effects in inflation, in financial system, affecting the well-being of individuals, of firms, oftentimes bringing countries to a brink. So through time, there has been a conscious decision in many societies that it is important to safeguard the country against these phenomena. And therefore, for precisely political and social reasons, at different points in time in most of the countries of the world, it has been decided that it is important to have an institution within the state to have the primary objective to preserve the value of money and to keep the conditions for a healthy running economy. This implies in a way, a delegation of responsibility from the central government to an institution, to an autonomous institution. Now, if you think that there is this delegation makes sense only when only in cases where there could be tensions. So it shouldn't necessarily surprise us that they from time to time will be tensions, because basically what society has said is that this institution should do what it thinks or what it deems necessary to preserve financial stability and the value of the domestic currency. And oftentimes what needs to be done doesn't match with what central governments may want to see. What is important here is that society supports the central banks and that the mandate of the central banks reflects the preference of society. And as long as this holds, I think central banks are obliged to do their job.
Right, thank you.
Thank you very much, Natalie. I think the next hand raised was Alicia Gonzalez from El País. And I think you're on mute, Alicia, or Alicia. Yeah. So maybe unmute. We can see you talking, but we can't hear you. What I suggest is we go to the next question and you try and fix the sound. So the next question would be from Paul Hannon.
Hi.
Hi.
So can I go back to Augustine's answer to the first question? Because as it went on, I became less sure of where we stand here. Are you saying that, what we've seen recently, the president calling the head of the Federal Reserve a moron is just, understandable to and fro and in no way threatening the independence of the Fed, because which will hold as long as society more broadly supports the independence of the Fed. Is that the right way of understanding your comments?
So
I mean, let me say that I'm not commenting. I'm making a general comment, but I think that the general comment is right. I mean, it is to be expected that at different points in time there will be friction, because that's precisely why the central bank has been in many countries of the world, the autonomy of the central bank has been granted. I mean, it's almost something by design. Of course, what it would be desirable is that this friction do not exist, But that is something that goes beyond the capacities of the central bank, I mean, the central banks are mandated by society to do a job, and in the way and using its instruments pursuing that mandate at sometimes might not be in line with what the executive power might expect, And this holds everywhere. This is not only an issue in the US.
So that verbal to and fro is not actually a threat to the independence. It's a kind of normal state.
As long as society supports having an institution within the state with the mandate to preserve stability, it should not be a threat.
Okay, thank you.
Thanks, Paul. So we maybe try and go back to Alithia. Alithia, maybe we can see if your sound is back. Still not back. Okay, if you want to type your question in the chat, then we go to the next question, which I think was from Tim Wallace from The Telegraph. Tim?
Hello. Thanks for the presentation. I wanted to ask on fiscal policy. Are governments listening to your warnings and to markets' warnings? There seem to be a lot of examples around the world at the minute where the French government struggling to reform pensions, the British government struggling to reform welfare benefits. Obviously, there's this big, beautiful bill in the United States as well. How worried should we be? What sort of trajectory do you think we're on at the moment?
Augustine, do you want to take that?
Yeah, it is quite obvious. I mean, because the figures are very eloquent, that the debt over GDP in many countries have been risen quite fast during the last decades, and that this trend cannot continue. Well, so what? At the same time, we are not saying that in this or in other country or in this region or in another, a fiscal crisis is imminent. But we're just saying the trend is not the right one, So usually to adjust fiscal positions, you need to start acting with time, I mean, especially if, because fiscal adjustments sometimes might imply, some costs for the economy. Now, the sooner you start and the better you think the strategy, the likelihood of this having a negative consequences on the rest of the economy, at least in the short term, could be minimized. No? So, I mean, if you look towards the medium and long term, it is important for this adjustment to take place. Again, markets could be stressed at different points in time because of the amount of debt that is out there. And the other thing that concerns us is the fact that, you never know when you might have to implement again an aggressive fiscal policy to stabilize. I mean, let's take the example of COVID, COVID was completely unanticipated and it definitely required a fiscal response. But once you do the fiscal response to overcome the challenges, it would be important to rein back the fiscal expansion and to reestablish fiscal space to have the capacity to respond in case necessary in the future. So that's really what we have in mind.
Hyun, did you want to come in as well on that?
Yes. So, Tim, I think let me just add a couple more points to what Agustin just said. I think the sustainability is the key. But there are a few other points, some of them actually related to financial stability as well. I think we have to think about so even if debt is sustainable, there could be a sense that that debt is too high. If, for example, debt servicing costs are actually higher than some of the core items of expenditure in your economy, education, defense. At the moment, debt service is actually very high. And then there are some financial stability aspects as well. So one aspect is the valuation losses that come from having very high levels of government debt held by financial institutions. So when interest rates rise, the valuation falls. And so for leveraged institutions, that could actually eat into solvency. This is what happened with Silicon Valley Bank a couple of years ago. And a fourth reason, it would be the kind of liquidity stress episodes we've seen in the GFC during the March 2020 episode, when even in safe asset markets, you can have liquidity stress. So financial stress is not simply about credit risk, it's also about liquidity and deleveraging and so on. So those are all the reasons why we should be very careful about sustainability and levels of debt. But don't forget also the importance of the multiplier there as well. So we talk a lot in Chapter 1 about the importance of having the right forms of fiscal expenditure as well as the amount. And the structural reforms that we often talk about also includes public investment. I think this is actually very sort of important in an era when growth is low. So you want to ensure that fiscal policy is going to be supportive of growth rather than simply add to the risks.
Thank you very much.
Thanks, Tim. Next question for Daniel Hinge in central banking. Daniel?
Hi, thanks very much. I wanted to ask quickly about the annual report. I see that BIS's income hit a kind of new record high in the past year. Can you say about kind of anything about what drove that result? I know markets were pretty strong last year in general, but were there particular banking products that central banks were in kind of high demand with central banks?
Okay, thanks very much. Two parts in the annual report where we talk about both the transformation and then the year itself. Augustine?
Yes, thank you for the question. I mean, in the report, we spent a lot of space to document basically a major modernization of our banking operations. And I think this is a result of this strategy, you know. I mean, basically, we decided to revise how we do how do we serve the central banking community, and many different aspects have been enhanced. It goes from issues as simple as having much better technology and systems for them to transact, for us to provide them a good service in all the different aspects of transactions, from back office, middle office, execution of a transaction, and so on and so forth. And well, I also think that it has been playing a very important role. The fact that the BIS is the highest possible credit worthiness that you can find out there, you know. So I think that the strength of the institution at the end gets rewarded by us attracting additional deposits. We have increased our capital substantially during the last years, even though Basel III doesn't fully apply to us, but you know, we like to follow it just by consistency. We have a capital to asset ratio that is probably the highest in the world. So I think that this enhances the trustworthiness of the institution, and this has been reflected in increased volumes. So there is not a single thing, it's just a comprehensive strategy that we have been following, and this, thank God, is being reflected in the figures.
Great, thank you. I think Andrea might like to add something on that. Andrea?
Just a small detail that I'd like to add to what Agustin said, and it's I think what is also not to underestimate is the importance of our representative offices of the Americas in Mexico, of the one we have in Hong Kong for the Asia Pacific. This allows us not only, of course, to be on a 24/5, not 7 days, given that the markets are closed, or 6 days, if you look at over the globe, but it also allows us to have the sufficient local imprint and to be able to be sufficiently customized and to really be present in these different regions and yet use the whole balance sheet to provide the right kind of efficiency to our customers.
Thank you, Andrea. Thank you, Daniel. Next question, I think, to Carlo Boffa of Politico. Carlo?
Hi.
Yeah.
Yeah, now you can see me. Hi,
We
good
can hear you
afternoon.
there. Afternoon.
Thanks for taking my question. I've got two. First is on there is a box in the first chapter of the annual review, and it's about tariffs. And it says very bad things about tariffs. Tariffs are very bad. That's at least my understanding. So I wanted to ask, is there any one, even small, economic benefit you could point out that tariffs could bring about? And what should countries at the receiving end of tariffs do? Should they really just avoid retaliation, as many people seem to suggest? Then the second question instead is more on central banks. In the annual review, you say that central banks would better introduce scenario analysis. So I want to ask if you can expand a little bit on that to explain a little bit why you think that scenario analysis would be beneficial for central bank compared to, for example, I don't know, explain the reaction function, like what's the edge that the scenario analysis would have. And is it a problem, for example, to publish scenario analysis for bodies that they are maybe policy-making bodies that are bigger? And would you see a way around it? Thank you.
Okay, thanks very much. So there's two parts to that question: the scenario analysis relating to I think the monetary policy aspect, and then the other is more trade policy related. It's slightly outside of the central banking sphere. So maybe Hyun, do you want to start off, and then we can take it from there?
Sure. Thank you, Carlo. And thank you for reading the box on tariffs, which I think is I think it's sort of fairly mainstream in terms of the arguments, but we felt that it was important to, lay out the, the kind of key economic arguments. So the first point to make is that, and as we lay out in the box, if the objective is to reduce trade imbalances, then tariffs are not should not be the preferred tool, because the trade imbalances essentially they are the counterpart to the difference between spending and income. And so if the objective is to reduce trade imbalances, then macro policy, so fiscal policy, just demand management in general, turn out to be much more effective in influencing trade imbalances. I mean, that's not to say that tariffs will not have an effect, because there are general equilibrium effects that will ripple through the economy. The point is more that if the objective is to reduce, then the most effective way of doing that is through demand management. Now, your question also raised the question, are there circumstances in which tariffs may be beneficial? Now, one of the arguments that we consider in the box is the so-called infant industry argument. So if you're, in particular, a developing economy and you're developing a manufacturing sector, and you would like the manufacturing sector to nurture the manufacturing sector, then there are accepted arguments within development economics that you may want to put in protection for a while your domestic industry actually stands on its own feet. But again, tariffs are just but one among many different policies, and it's not clear that the tariffs will be the most effective. You asked whether countries should retaliate. Of course, if you look at the underlying principles, the best outcome, given the actions of the others, would be not to retaliate. But there could be reasons why you might want to engage in more of a bargaining stance. So that could be one reason why you might retaliate. But I think there is also the importance of the domestic policy support, and I think that's also going to be a very important element of that. On scenario analysis, one of the themes that we have in Chapter 1 is the importance of central banks being realistic about how much they can forecast, and to be able to lay out the full range of potential uncertainties in the future path of the economy. And this has always been a challenge for central banks, because even though you may have a central forecast, there is a great deal of uncertainty surrounding that, and there are lots of, if you like, contingent facts which, if they realize, will affect the economy in different ways. And one of the ways that that central bankers have thought about this is, perhaps you can convey that sense of uncertainty better if you were to present scenarios rather than simply these fan charts where you have a central projection and then the uncertainty around that. And the recent report that Ben Bernanke wrote for the Bank of England was a very good example of a discussion where the benefits of scenario analysis would be could be actually very useful. I mean, this is not a kind of cut and dried argument, but think of it as being part of the communication discussion of central banks. How do central banks best communicate with the public?
Thanks very much. So Alicia has typed her question in, so apologies for the sound earlier on. Alicia is asking, are we seeing the impact of fragmentation and protectionism in sovereign bond holdings and debt issuance, and is that having any impact on the dollar status? So, Hyun, do you want to take that? Thanks.
Thank you, Alicia. So let me take that in two parts. In fact, there is a bulletin that we published on Friday. Actually, we can send you that on the market events in April and May. So the first answer to your first question was, do we see any evidence of fragmentation in government bond holdings? The short answer is no. And in fact, we had from the US side, we had the April release of the Treasury International Capital Markets survey of bond holdings. And that shows a slight decrease in the foreign holdings of US debt securities, but it's of the order of 50 billion, which is really very small compared to even the usual day-to-day fluctuations. But I think what your question is also alluding to is the fact that during April and May, we saw this very unusual combination of the triple decline. So there was the fall in the stocks, fall in bonds, and the fall in the dollar. And that last part was particularly notable because that's a very unusual occurrence, that we have a weaker dollar when there is a risk-off tone in the markets. Now, what we say in the bulletin, and we sort of dug into some of the numbers here, what we say in the bulletin is that, in fact, we can probably attribute that triple decline to the ex-post hedging behavior of investors, non-US investors who are holding US securities. And it's, if you like, hedging behavior that was intended to mitigate the loss that could possibly result from an even further, a further depreciation of the dollar. And the background to this is that because of the recent period of a stronger dollar, as well as very high hedging costs, non-US investors had entered the episode with very large unhedged exposures. So they were holding US securities without the currency hedge that came with that. And so as the stress event broke out, these investors were hedging ex post. So they were putting on hedges as a result of the stress. And as we explain in the bulletin, that hedging operation itself entails selling dollars in the spot market. And so that was probably the prime reason why we saw that particular combination. And we also lay out some other evidence pointing to why that is the most likely story. Now, of course, having said all of this, I think we have to watch very carefully. So even though there hasn't been this very large fragmentation in financial asset holdings, the strategic asset allocation changes of long-term investors take many months to actually unfold. So, of course, we cannot rule it out, and we would, of course, have to watch this very carefully going forward.
Thank you, Hyun. And just to thank everybody for being patient, because I know there's still hands raised. So we go now to Mark Jones from Reuters. Mark.
Hey, can you hear me?
Yes, perfectly.
Great. It's actually just a follow on from what you said, Shin, maybe, but also what Augustine was saying, you were saying earlier. Given the scale of the dollar move this year, and you're saying, Shin, that you have to watch it very closely. Ultimately, what could the implications of all of this be? I mean, would you kind of ascribe to the view that we're seeing something of a great rotation, as some people have suggested? And a kind of second question also, Augustine, you're talking about you don't know when you might have to return to aggressive policy measures as a central bank. And, we could point to the fact that some central banks are even back at zero in terms of their interest rates. Do you think we're going back into that era?
Hyun, I think that one's for you.
Well, thank you, Mark. I think you asked, are we seeing the great rotation? I think the short answer is it's not in the data. So as I explained to Alicia, if we look at the portfolio data, we don't see that. But as I said in my answer to Alicia, of course, that doesn't rule out there could be a move. And so this is why watching very closely the strategic asset allocations over the medium term will be very important. And I think this is where I think you and other colleagues in the press will play a very important role, because you are actually conveying the conversations that are going on in those boardrooms, and so I think this is something that we will need to watch, and you'll be a very important partner actually as we monitor that situation. On the future direction of monetary policy, I think a very important feature to bear in mind is that the recent tariff policy uncertainty and the associated introduction and then the reversal of the policies. I mean, those, although some of the very high rates that were mooted during the early April episode have now receded, tariff rates, the basic tariff rates, are still fairly high in the US, and so that sets a kind of very important backdrop. Those tariffs will of course have the textbook effect of imparting upward price pressures, but also a downward bias in activity in the countries that are imposing it, but also a downward pressure in activity in the countries that are on the receiving end. We also point out the importance of the uncertainty element here as well, because with many large, big-ticket items, big-ticket corporate investment projects, uncertainty tends to delay those projects because there is an option value of waiting, and that tends to dampen demand, especially in the activity that's related to investment, and FDI would be, particularly affected. So I think that's going to be it. Yes, go ahead.
If you perhaps answer that, the other bit of my first element of the question as well was that, if you were to determine, or we were to see it in the data that we are seeing ultimately a rotation out of the dollar, what implications would that have? Do you think? How seismic would it be?
Well, I wouldn't say it's seismic. I think it's if you look at the hexagon chart in chapter 2, and I think that we're rather pleased about that diagram, because I think that sort of gives you a very bird's eye view of both the size of the portfolio flows that have happened, but also the interconnectedness. And it's certainly true that the US capital markets are playing a very, very important role, and therefore the dollar is a key sort of pillar of that system. But these things move very slowly, and portfolio adjustments are a very natural feature of any financial system. So I don't think that's so I think the short answer to your question would be, we haven't seen anything that would give us cause for alarm. I think it's something that, of course, we have to watch very carefully. But most of the market moves have been about hedging activity rather than something fundamental.
Thank you very much, Hyun. And next question to Craig Sterling from Bloomberg. Thank you for your patience, Craig. Are you there, Craig? Craig has had the hand up for a while, so I'll give you a moment, Craig. If not, a couple of people have a second hand raised. So give Craig a moment. Okay, if not, then I might just go back. Then I saw Thomas Chow from Central Banking also had a hand raised. Thomas?
Hi, can you hear me?
Yeah, perfectly.
Hi, great. Thank you very much. This question, actually two questions, is to Dr. Shins on currency hedging and a weaker dollar. So the dollar has weakened for a little bit for a variety of reasons that we don't have to go into. And what you have talked about in the bulletin and what we've also seen is that this weakening dollar is pressuring funds, for example, life insurance companies in certain segments, for example, Asia, where liabilities is domestic, but they invest abroad. Now that a couple months have passed with this sort of like a weak dollar environment, are you still seeing pockets of risk here with a weaker dollar and the investment portfolio? And the second question is a related one: is what does a weaker dollar mean for financial stability globally in general? Is it giving rise to pockets of risk that maybe we're not aware of? Thank you.
Okay, Hyun.
Yes, thank you, Thomas, and thanks for reading the bulletin so carefully. On the financial stability risks, I think we saw the April episode as being, if you like, the peak of that stress period. We've had a very rapid, calming down of markets since, and as we write in the bulletin, one of the reasons why some of the institutions were vulnerable to a weakening dollar was because they had entered that period with very low hedge ratios. So, as you say, even though the financial institution has obligations to the domestic policyholders or beneficiaries in local currency, they were holding US dollar assets without the hedge. And there were various reasons for this that we explain in the bulletin. But one of the reasons why we saw the sharp weakening of the dollar in April was precisely that there was a move to put on the hedge as a response to the volatility, but also to mitigate potential future losses if the dollar were to go even lower. But there is this feedback effect where if you hedge more, that actually pushes down the dollar more, and then that could elicit more hedging activity. So I think one of the things we should be looking for would be when will the hedge ratios go up to something like normal, and then I think that would mean that we're actually at some kind of equilibrium. What are your second question was on the financial stability consequences of a weaker dollar? Well, actually, the empirical evidence shows the opposite. So typically, it's when the dollar is weak that actually you have more of a risk-on tone to markets, and there are various reasons for this. But the short way of explaining this is that a stronger dollar is typically a barometer for a risk-off episode. It's a kind of it tends to reduce leverage. It tends to lead to a recoiling from risk and so on. So a weaker dollar would not be something that's typically bad for financial stability.
Thank you.
Thank you very much, Thomas. I would suggest that we go. Natalie had a supplementary question from Agence France Presse. Natalie. Okay, Natalie, you're on mute.
Sorry.
No.
Yeah,
Good.
I just have a follow-up on my initial question. If you could re-explain us what are the benefits of having an independent central bank, and what, on the opposite, are the risks of not having an independent central bank? And if we take a wider lens, because the central bank can be a quite mysterious institution for the general public, why is it as important as, for instance, the independence of justice to have to make sure that the central bank can take its decision independently of political pressure?
Thanks. I suppose we don't answer in any relation to any specific institution, but Augustine, you've many years of experience. I'm sure you can give your perspective.
Yeah, our modern societies, modern financial system depend on fiat money, which basically means that there is no physical support to money, and its value and its functionality in society depends on people wanting to receive it as payment and also as unit of account and as a store of value. Now, this has been achieved precisely by the governments taking as an activity or as a responsibility to provide society with money. Now, with the capacity to issue money without any backing, that is very powerful. But at the same time, it entails a lot of responsibility. And the main issue is to prevent that huge responsibility is abused. Because if it is abused, then the value of money deteriorates, and that has very, very important social consequences. Like, if you have very high rate of inflation, obviously the purchasing power of individuals is affected, real wages go down, pensioners on a fixed rent suffer, the value of savings is eroded. Also, if people do not have certainty on the value of money into the future, investments can be contracted, interest rates increase, and so it really generates a huge list of negatives. And there are many examples, both in advanced economies, but also in emerging market economies, probably more recently, where you can see the devastating effects of all this process to run out of control. So that's why it really behooves on society to preserve. I mean, this is a great invention. A great invention in society has been the creation of fiat money. But precisely for it to function, we need to use it within reason. And that's what the central bank is meant to protect.
Thank you very much, Augustine. Thank you, Natalie. And Craig has put his question in the chat. So he is obviously looking at the vulnerabilities we mentioned in Chapter 1 and talking that inflation features a lot. So I think a follow-on from the last question, more so than among the risks that he's seen highlighted by the OECD and the IMF. So looking at the vulnerabilities for inflation, could we expand on that a bit in the comments? So Hyun, do you want to take that question, or Augustine?
Well, let me just start.
Yeah.
I think one of the issues is that I think what is important to keep in mind is where are we coming from. I mean, as we said at the beginning, we were meant to have a soft landing. Everything was going according to plan. Then we had this very substantive period of volatility with the threat that the tariffs could make more difficult the convergence towards the 2% in some countries. No, we have also documented. So I mean, to start with, in some countries, not in all of them, the process of convergence is going to be more difficult. On top of that, and we mentioned this in our report, inflationary expectations hasn't really converged to where we would like them to see. I mean, it takes time for people to as a matter of fact, make the differentiation between price levels and inflation. Many people in society, given the fact that prices increased and didn't come down, they still believe that inflation is very high, even though inflation is low. So that makes the inflation expectations resistant for convergence, and that's why what we reiterate in our chapter is for the central banks to be very vigilant for any resurgence on inflation or major developments in inflation expectations. Of course, the tariffs and other developments also could have an impact on economic growth, and that might reduce the pressure on inflation in some latitudes. But in others, like in the US, you could face a very difficult scenario for the central bank, which is when you have higher inflationary pressures or deviating inflationary expectations and a slowdown in the economy. That is a circumstance that central banks usually find particularly difficult. So I think that's what we have inside. I don't know, Hyun, if you want to complement here.
Yes, Craig, I think just to add to what Agustin said, I mean, in theory, a tariff would be a one-off price shock rather than an inflation shock. But the key is the inflation expectations that Agustin mentioned. And you may have seen that last week we published a bulletin on household inflation expectations. And there are some very important findings which I would urge you to look at there. And it's also picked up in one of the boxes in chapter 1 of the report. But in a word, the recent COVID inflation has really made inflation expectations very, very sensitive to realized inflation. So as far as inflation expectations are concerned, it's a case of once bitten, twice shy. So this is why I think it's very important to make sure that just a one-off price increase does not translate into a sustained inflationary episode. Now, actually, even just a one-off price increase, could also be an issue if, as seems to be the case, households just really don't like an increase in the price level itself. So, in the recent COVID, inflation episode, as you know, inflation was a very unpopular phenomenon in many economies, and this was in spite of the fact that inflation was brought down eventually, close to targets. But there's something about the price level itself that households really react, badly to, and so I think that's that's a second reason why you would be, very wary of inflation picking up again. And the last point I would make about this is we know that household inflation expectations tend to overstate the actual level of inflation. There is a bit of an upward bias in those surveys. But irrespective of that, if that upward bias then leads to actions on the part of economic agents in the economy, then of course it doesn't matter whether they were correct expectations or incorrect. If it actually affects actions, that of course would be another reason why you would be very wary. Andrea?
This is really a very important point, both what Agustin and Hyun said. So let me give you maybe an example or a contrarian example. So we used to really be faced quite often with a one-time price shock. Think about the oil price shock. We used to have them regularly, some bigger, some not. And I'm not going to the 70s, but the last 20 years. And what would happen then? Right? So you would have to pay, everybody would have to pay more when you go to the pump. Household may spend less on other things, but there was no fear that particular increase in price, which would be binding for society, for household, for firms, there was no fear that would change your inflation dynamics. It was a one-time price change, and there would be an adjustment to it. And people would expect that inflation would stay low. There might be an inflationary pressure, a temporary inflationary pressure, but it goes down. That world has ended. Well, at least for now, with the COVID, we've seen, because households have seen really negative real wage growth, where suddenly the inflation really was much stronger than the wage growth. And now there's a much bigger sensitivity whenever you see any price increase, the fear that it's not just a simple price increase, but that it affects the inflation dynamics. And this behavior really has a big impact on inflation dynamics, and of course then on how central banks have to think about the response to any shock.
Sorry, if I can just ask, another vulnerability involving inflation that you stress in the chapter there is about stress in sovereign bond markets that can be more easily originated from and be propagated through stress in sovereign bond markets. I mean, how does that relate to that I take it is not specifically about household inflation expectations. It's about I mean, I don't know. Could you just expand on that very, very briefly?
John?
Well, let me say
Augustine,
things. When in interest rates, as you very well know, there are risk premia involved, and there are different events that could really increase risk premia, and in a way that is what is happening. I mean, the perception that there might be more inflation into the future is reflected in the pricing of long-term instruments, and these obviously have a subsequent impact on the rest of the economy. So those are issues that are very, very important and that are reflected in financial markets.
Yeah, I mean, really not much to add to that, actually. So, when we do these yield curve decompositions, we can allocate how much of the nominal yield is due to, a fair pricing of inflation. But then there's always an inflation risk premium that actually comes on top. And this is on top of the usual kind of risk premium measure.
Thank you very much, Hyun. And we have one final question. We've gone slightly over time, but she's patiently been waiting. So Arantxa Iniguez from EFA in Spain. Arantxa, are you there?
Hello, can you hear me?
Yes, we can hear you.
So I have two questions, if I may. The first one, NATO countries have decided to increase defense spending to 5% of GDP. Do you think that the decision could put pressure in the fiscal positions of some countries? And my second question is about the situation in the Middle East. Which economic impact do you expect of this situation?
Okay, I think these don't
let me say the first one, or the first. I mean, definitely, if you have to devote more resources to military spending, that would have a fiscal impact. And it will depend on how the different countries will address this. I mean, there are some countries, for example, like Germany, that has fiscal space, and therefore they can increase their deficit, and they can increase the debt issuance. Others might have to reallocate resources, but it's up to each country how to face it, no? And then with respect to the other, well, I guess that the most immediate reflection of issues in the Middle East traditionally is the price of oil, and that's something that we already saw some flare-ups in the price of oil during the last 2 weeks. Now it depends on how sustainable this is, because obviously if it is sustainable impact that would affect, it's a shock. It should be, as Andrea explained a few minutes ago, traditionally it could be a once and for all, but depending on its permanence and so on, how it affects inflationary expectations, it might have more serious consequences, and it might trigger some policy reaction. But at this moment, I wouldn't be anticipating a major problem there.
Thank you very much. And that was our last question. So this brings our briefing to a close. A reminder that this discussion and the chapters and press release are embargoed until Sunday, the 29th of June at 11 a.m. Central European Summer Time. And if you have any follow-up questions, we're of course happy to deal with you. Let me take this opportunity as well to thank Augustine especially, along with Yun and Andrea for this briefing. This is Augustine's last press briefing here at the BIS. He leaves us on Monday after a long esteemed career in central banking and goes on to new activities. I'm sure we'll hear from you in the future, but on behalf of us all here in the BIS and I'm sure the media who you've engaged with over the years, warm thank you. Thank you. Take care.